Welcome to Market Monday from the investment team in the trust department at the First National Bank. Looking to the economic calendar, we can see right away that over the next week, we don't have a lot of data points coming in on the economy. That'll change next week, but for now, things are relatively light, although impactful, because these numbers, sentiment, labor market numbers, and information in particular, in our case, we think in wholesale trade and wholesale inventories, are key to determining where we're at in this struggle between the Federal Reserve's attempt to get interest rates to a place where they can control inflation versus potentially giving us a hard landing or a recession, which is our base case forecast and that of many other analysts. So this week we get information about, international trade, the labor market, sentiment. These are important things because they tend to be, forward looking. However, the information on wholesale trade and wholesale inventories, which normally doesn't get a full bar of importance by Bloomberg, we think is going to be rather pivotal this week because it indicates the degree to which the economy is potentially slowing down. Specifically, if inventories are rising, and in this case, they're forecast to have risen by about 0.1%, while demand is falling and sales is falling by about 0.2%. That indicates that potentially wholesalers are getting less orders from retailers who are presumably ordering less inventory in anticipation of a downturn that they're already seeing signs of manifesting. So we're looking for that to telegraph. And if those numbers come in unexpectedly aggressive, in other words, if the inventory rise is bigger than expected and the slowdown in trade sales is bigger, lower than expected, we're looking at the odds of a recession significantly increasing and potentially its severity as well. So we'll be watching that, as will the rest of the street. Moving into next week, we get consumer price index. We get retail sales, which being 2/3 of the economy is very important and will give us another clue. Are consumers continuing to spend in the uncertainty in this turbulent environment that we're in, or are we continuing to see robust demand? Industrial production and capacity utilization, the health of the overall industrial sector, building permits, housing starts, more real estate information, more labor market information. Then the producer price index, which is key and pivotal in terms of, is this inflation really remaining in a slowdown pattern, or is it starting to find traction and hold, or potentially starting to rise again faster? And if that's the case, it indicates that markets may have overshot the Fed in terms of misinterpreting what was said. And let's be clear, going back to Friday, we had a pretty hawkish statement that accompanied that rate hike. Yes, the rate hike was only 25 basis points, which was expected, and the markets took off on that news. However, the language suggests they are in no way becoming complacent about this inflation. And it was even specifically stated that there is no intention of lowering interest rates in 2023. The market seems to have ignored that statement. It seems to have also ignored the idea that, rate hikes up to the 5% and a little bit higher than that area are going to be necessary. And we'll see whether that's justified or not. We get the leading index, which gives us a forward look at GDP expectations. We'll get the purchasing managers index, giving us some more sentiment. We'll get the GDP revision for the Q4 GDP growth. And if that number comes in hotter than expected, that indicates the Fed has more work cut out for it than expected. If it comes in lighter than expected, that actually might indicate, hey, the Fed's on a good track and maybe the market is not at odds with the Fed in going up because maybe the Fed is on track to achieve a slow, soft landing. We'll get income information, spending information. We'll get more information about sentiment, and that'll round us out. Want to look at the big picture on the S&P 500. And we're going to come back to this in just a moment, although we are going to go to a 1 year to see what's been happening recently. And again, we've highlighted this in the past few sessions and in our speaking event the other day. This activity at the end of the year where markets held a really tight range in reasonable volume, despite the fact that most traders were on vacation and that we had some significant news catalysts, news items that came in unexpected ways that potentially could have moved the market a lot further than that tight little range. So that's indicative of strength in the market, and we've been going up since then, all the way up until the end of last week when we had some information that suggests maybe the market might be getting ahead of itself in interpreting the Fed. coming back to that, what has the Fed said? The Fed has told us that they expect interest rates to rise to a little over 5%, about 5.1, at a maximum rate at some point in this year. And then, taper off or hold there for a good while. And it seems that the market is discounting instead rate cuts at the end of 2023. And that was explicitly said is not on the Fed's radar at all during the latest press conference. So it'll be interesting to see what these inflationary type indicators show us. And is the Fed in fact potentially on a softer track than its verbiage? Or is it in fact telling us like it is, and the market may have misinterpreted that just because they only raised by 25 basis points? But to be clear, this dot plot here, the majority of the Fed governors think we're going to top out at around this 5.1%, and it's also not expected that we're going to see rate cuts at any point in 2023. So, speaking of rates have come down a little bit in the corporate bond world, although are still very good for income investors. You can get 4.46% on 5-year paper. You can get 4.6% on 10-year paper. That's relatively flat, so our bias is to remain short-term on the yield curve. Coming back to the market in this chop, yes, it's been a turbulent year, and yes, we're looking at a recession as our base case, along with many other analysts. But with that said, the market is behaving in a pretty strong fashion, and the markets tend to look out a year and a half or more into the future. So we may be seeing a bottoming process in advance of an official call of recession, or potentially, and this is not the most likely outcome, but it still could happen, the Fed may be able to engineer that proverbial soft landing. And if that happens, the economy doesn't stall, we escape recession, and we move forward. But earnings season has been a bit challenging, and a lot of companies have come out and adjusted downward their forward-looking guidance as to what earnings is going to be. And it's in light of the higher inflation in the environment, declining margins, and declining sales forecasts. So that bears watching, because ultimately the markets and equity prices are driven by earnings. But again, and we're going to come to a conclusion here, and we'll finish this out, we're long-term investors. So this short-term chop in the context of a longer-term time frame and the type of period that we're holding for, whether it be a few years, 5 years, 10 years, 20 years, we don't want to make changes to good long-term plans that are designed to take advantage of time in the market because there's some short-term turbulence in the market or things that are less than ideal in the short term. So hopefully you found this informative. We're advising sticking to the long-term plans. And, if you have questions about that, if you have concerns about that, we're happy to talk to you. Feel free to reach out. Hope you've enjoyed. Thank you. Have a great day.